So let's go through a case study. A lot of you guys on here are active landlords, and you may or may not still enjoy it. So one of the things I do many times every week is do a financial analysis for someone with their long-term or short-term rental. And if you have one that you're questioning, even if you've got a phenomenal loan on it, set up an appointment with me or with Nick, and we can very quickly help you figure out if you continue to hold on to that rental over the next 10 years, how much wealth will you generate for your family? If you decide to sell it and not do a 1031 exchange because you're kind of done with this, and you paid the taxes and you invested in the stock market, what would that mean for wealth accumulation? If you put it in the medium-term income fund to generate just pure income and not appreciation, what would that do for you? And then if you decided to invest in one of our long-term funds, well, how would that perform? And then I can give you all the facts that you and your family need to make an informed business decision about what the right path forward is. And it's easy to do. It doesn't take a lot of time, and there's certainly no obligation to any of that. So I'm going to show you something that I did for myself. So I've got a number of long-term rentals. At one point, I had 140. I'm down to less than 20 now. I've sold a lot of them off. And I've got about a dozen short-term rentals. So this is an Airbnb on Bijou Street in downtown Colorado Springs. It's a beautiful Victorian. It's been fully renovated. It's just a couple blocks away from downtown in a primo location. And I've had 4 or 5 years of really great financial performance from this asset. It's really had some great returns. Unfortunately, there's a lot of people with really low mortgage rates, thanks to Joe Massey.
You're welcome.
Who don't want to sell their rental properties, or sell their properties rather. So if they're getting transferred to, say, Dallas, and they're a financially strong person, they will be able to buy a home in Dallas and still keep their old home in Colorado Springs or Denver. And half of them are putting it into the short-term pool for Airbnb, and the other half are putting it into the long-term rental pool. So the amount of competition on both the short-term and the long-term side has increased quite a lot recently, thanks to all these people who've got really cheap interest rates. The demand for these rentals has increased, but not nearly as fast. So what we're seeing is the short-term rental market is a little bit overly glutted with supply. No one's getting as many room nights, and no one has any pricing power. So here's my Airbnb in Colorado Springs. You can see it's a pretty nice looking place. It's done really, really well over the years. And I did this little analysis to try to figure out, well, you know, my revenue is down a lot. So the blue line is the actual over the last couple of seasons, and the red line is the projection based on what I think is going to happen next. And you can see that in the upper left, like my revenue a couple of years ago was 95 grand, and now it's under 60 grand. But my expenses now are higher than they used to be because insurance has gone up, my property taxes have gone up, and all of my labor costs for everything have gone up. So if you take a look at the cash flow after the mortgage, you can see initially I was generating a lot of free cash flow even after the mortgage payment. And now I'm at break even. I'm projecting to be at a slight loss next year. I have a fixed 5-year loan that's going to reset in February of next year. And then when that loan resets, it's not going to be anywhere close to profitable. I'm going to be like bleeding money on this. So this was not a property that required a lot of advanced analysis to figure out, like, I've got to sell this. But I did this with all my rentals, and there were some other ones that I need to sell as well. So I won't do anything as elaborate as this. I'll do something simpler for you. But if you've got a property where you're wondering, like, wow, should I keep this or is it time for me to sell? I can help you think through all those topics to figure out what you should do. How do you do that? You go to irontoncapital.com /book now, and you can set an appointment with any of us on the team. Joe, are you seeing for people who decide they still want to be an active investor, like, are the rates favorable enough that it's easy to get something to cash flow?
No. If you are buying a property right now based on insurance, taxes, HOA, and interest rates, you got to put best case 30% down to break even, 35 to 40% down if you really want to cash flow.
That's what I'm seeing, and our expectation. Well, I shouldn't lead the witness here. Joe, do you expect that mortgage rates will decline quite a lot over the next couple of years now that the election is behind us?
I do not.
I'm in the same boat. I think that you're going to see rates drop a quarter point or a half point over the next year, but I don't see they're going to drop materially. So the people who are not active investors, who have the desire to be an active investor, may not really have a choice in that there's not a lot in the near term they're going to be able to buy that's going to cash flow really all that well, unfortunately.
Hey, Lon,
nothing lasts forever. Yeah, go ahead.
I had some of that. So I had an interesting conversation with an investor yesterday who's looking to 1031 about $230,000 from the sale of 2 parcels of land. And he could not find anything to cash flow. He's looked at about 10 to 15 different properties. And every single property that he looked at, he would be sucking about $100 per month into the property, which I found to be very interesting because I think that's really a sign of where the market is. And I think it's a reflection of the interest rates, the rents that are out there, and the type of property from a valuation standpoint that you're going to have to buy. So I thought that was a really interesting conversation that I had with that individual.
That's great. So a lot of people who currently own a property and are sort of tired of being a landlord are really worried that the capital gains taxes are going to be really a large barrier from doing anything other than a 1031 exchange. And you'll want us to do the analysis for you so you can see exactly what kind of impact that has. Usually we find that over a 10-year period, it's okay to pay the taxes, especially since we can usually offset some of them with our depreciation, and that you might do okay. So Paul was asking, do we qualify for a 1031 exchange? Not directly. So the long-term fund, Paul, has got one share class without depreciation and one share class with depreciation. So a lot of our investors invest with, say, an IRA, so they don't need depreciation. So the small number of people like you, for example, can get a disproportionate amount of the depreciation that our investments generate. So you'll want to talk with your CPA, but what we generally tend to find is that the depreciation we generate in the first year can be used to offset a decent amount, sometimes quite a lot, of the 1031, the capital gains that you would experience from selling a rental property. So it's not the same mechanism as a 1031, but it accomplishes a lot of the same results, and we can model your exact situation for you.
It's kind of like a 1031 light.
Yeah, that's a good way to express it. Absolutely. So I'll just talk briefly about the National Diversified Fund. This actually kind of fits in with Paul's comment. Our goal is to invest for 4 to 6 years, a 17 to 20% return, and there is an option for accelerated depreciation you can use to offset the capital gains you might have if you sell a rental property. If that's of any interest, let Nick or I know, and we'll get you a lot more information. I want to mostly focus about where to park your cash tonight because that's our theme. But for many of you, this might be part of your solution.
Hey, Lon, I got one common question I get, and for a lot of people on here, maybe you are new to passive investing. Is that 17 to 20% annualized, or is that total over the 4 to 6 years?
That is annualized. So the goal would be on a typical fund, if you put 100,000 in, that we would return your 100,000 back and about 90,000 of profit on top of that. And our goal is that the majority of that return is a long-term capital gain, not ordinary income. So it's a more favorable tax bracket. And we've run about 15 of these funds over the years. So this is kind of our overall list of all of them that we've done. And you can see the initial IRR, that's internal rate of return, so return on investment, annual target, and then what our current estimate of where those will come in at. So I'm going to show you a real life example I did for one of our investors really recently. She bought a house about 10 years ago for, I think it was $200,000. It's worth $675 now, and she's got about $100,000 worth of debt. So her equity is $577. A lot of you who bought 10 years ago are in that situation, and you're probably sitting on a sweetheart mortgage at a low interest rate on top of it. The cash flow each year looks like this. There's about $40,000 of rent. Her direct expenses like tax and insurance and the water bill are $5,600. She's got maintenance reserves of $2,300 and a vacancy loss reserve of $1,200. So her net operating income, NOI, is $30,000 a year. She does have a mortgage. It's like very small. So if you have a mortgage payment, you would take that out of this as well. Since hers was so small and it's just about paid off, she's making extra payments on it. We just disregarded it for this analysis. So what kind of wealth generation is she getting on this? So she's got $675 of value. We think the property is going to go up 4% a year in value. over the last 50 years in Denver and most of the Front Range, the appreciation has been close to 6% a year. We think it's going to be a little less on average over the next 5, so we picked 4. So with the value of 675 today, 4% appreciation is $27,000 worth of appreciation every year. Her cash flow is the $30,000 that we talked about. So her total return is $57,000 a year. So if you recall, her equity after the debt is $577. So if you make $57,000 on an investment of $577, your return is just about 10% per year, which is not too bad. So what would happen if she did nothing? So if she does nothing, she has no transaction costs, no capital gains. So the amount that she can invest is $577, just no change at all. And her property equity is going to grow in total by just under 10% per year. That's this total return we talked about just a second ago. So after the first year of investment, her value will be $634. It's the $577 she started with, adding $57,000 is $634. Then next year, we're going to add on another 9.9%, and that's going to get us up to $700,000. And you can see that the second year gain of 63 grand is bigger than the first year gain of 57,000. So that's called compounding interest. You may remember my favorite Einstein quote is, compounding interest is the eighth wonder of the world. The man who understands it collects it, and the man who doesn't understand it pays it. And you can see that due to compounding interest, our gains, 63,000, 69,000, 75,000, 83,000. She's going to see her equity grow from 577 to 924 just in 5 years. And then if we go for another 5 years after that, you see that her equity will grow to $1.5 million. This is why I love real estate. It's just fantastic. So she's a little bit tired of being a landlord, though. She'd like to move on and be passive. So what would that look like? Well, if she took this property and sold it, she'd have some sales costs and some capital gains that I estimated. And of course, you'll want to work with your CPA to estimate those. So let's pretend we're going to sell the property and put it in the stock market. So I've got 577 of equity today, but I'm going to have transaction costs of 37 grand and capital gains of 49 grand. So what I'm left with that I can actually invest is 490. And the stock and bond market, if you take a look over the last 70 years or so, I put this in option 1 in the footnotes, and you can get this Excel sheet from us. I'm happy to share it with you. The average stock market gain since 1970 is 10% per year. The bond market on average is 5.3. If you did a traditional portfolio, 60% stock, 40% bond, which is a very common mix that a stockbroker would recommend, your return would be 8.1. You can change this spreadsheet to whatever you want it to be, but that's what I most commonly hear of our investors who are trying to decide between their options. That's usually what they're at. So if I've got 577 and I've got to pay the transaction costs and the capital gains, and if I can invest it at 8.1%, what will I have in 10 years? And the answer is, with my stock and bond portfolio, it's going to grow to be $1,070,000. So this $1,070,000 is not as good as the $1,005,000 I have just by doing nothing. But here, by doing nothing, I've got to continue to be the landlord and manage the property and not have a passive lifestyle, as opposed to with the stock market, I sell it, I pay my taxes one time, stick it all in Vanguard and forget about it, and I'm just off to the beach. So for some of our investors, that's a great option. What else could we do? Well, another good option is we've got something called the Medium Term Income Fund here, and we did a raise for Medium Term Income Fund 1 in late 23, and we're going to have MTI 2 probably in late spring of 24. And our goal for that fund is to pay between 11 and 13% annual interest, and that comes out every quarter. So the amount that you get depends on how much you have invested. The more you invest with us, the higher the interest rate. No surprise there. Let's pretend that you're going to get in the 12% bracket. We would be sending you 3% every quarter. So for our older investors that need this income to fund their lifestyle in retirement, this is really great. You could sell the income property you have today. So let's pretend you paid it off. You had $30,000 worth of income that you could live off of. With us, you'd be getting something on the order of $60,000 of income. So you would basically double your income from $30,000 to $60,000 by making this change. Let's take a look at how it all works out. So we would have to pay the transaction cost to sell the property. We would have to pay the capital gains tax. We'd have $490,000 to invest. And with the old property, you remember we were making just under 10% per year. We're going to make a little bit more with the medium-term income fund. We're going to make 12% a year. And over a decade, you can see this grows to where it's almost the same amount of wealth appreciation. Investing with us in MTI gets you to $1.5 million. Sticking with what you've got right now, also $1.5 million. So this is just sort of stylistic between the two. What do you more prefer? So if you still enjoy being a landlord, sticking and doing nothing is probably the correct answer. If on the other hand, you're sick of being a landlord, you could sell it, pay the capital gains tax, invest with us, end up in the exact same space wealth generation wise, but not have the headaches of dealing with the tenants anymore. So a lot of people are finding that to be very attractive. This is why we raised almost $9 million in 6 weeks for MTI. When I explained this to investors, it was like very easy for them to connect the dots. Note that this is quite a bit better than the stock market option. It's a very, very attractive opportunity. So one other option is you might take a look at our National Diversified Fund. So when I put this spreadsheet together, we were raising for NDF 7, but all of our National Diversified Funds work the same way. So when you're watching this, we might be raising for NDF 10. It'll be the same strategy. So something important about NDF is we have two share classes. One, if you don't need depreciation write-offs, and your CPA could help you figure out if you do or you don't, we could put you in a share class that you get a higher preferred return, but you get no depreciation. So if you're investing in an IRA, for example, that might be really good for you. If on the other hand, you're selling your rental house, you're going to incur this capital gain, it would be really nice to have a bunch of depreciation from a write-off in your investment with us, and you could use the depreciation write-off to offset some or maybe even all of the capital gain and wipe the capital gain out. So I can give you the broad strokes of this, but of course you'll want to collaborate with your financial advisor and your CPA for your unique situation. Usually what we can find is that for the investors that want a depreciation, if you invest, say, $100,000 in NDF, we'll be able to give you $40,000 to $60,000 of write-off in the first year. In this particular case, if you did the math and we talked to our CPA, we were able to offset all of our gain and defer the taxes until later, which was great. So what you have here is $577 of equity, and you've got to pay the same transaction costs as stock market or medium-term income. But what's great is you don't have this capital gains liability because she decided she would get the depreciation shares and offset her capital gains until later. So she has more to invest, $540,000, than the stock market or the medium-term income. That really, really helps a lot. For all of our national diversified funds, historically, we've been on track to return between 15 and 20% a year. Around 17% is our target. So how does NDF stack up to the other options? Well, over a 10-year period, you can see that you wind up with $2.6 million after the end of 10 years, as opposed to do nothing is 1.5. So you can actually sell the rental property, offset some or most of your gain, be completely passive and go and sit on the beach, and in 10 years you're going to have over $1 million more than you would have had if you would have continued being a landlord fighting with the tenants. So I think you'll want to take a look at this option and to see if it's a good match for your family. So one of our clients, Jay, has been really excited that we've been able to reduce the time he spends on investing and the headaches he's had. He used to manage his own residential rentals, and I think we're likely to do a better return for him than what he was getting on his own with a whole lot less work, which is really going to change his life quite a lot.